This is part 3 for advanced accounting on what happens when we are accounting for 100% consolidated financials subsequent to the date of acquisition, and the parent uses either the initial value, equity, or partial value method. What are the methods that are used for the internal accounting when consolidated financials are required? The parent can account for its investment one of 3 ways. They can use the equity method, which adjusts the investment account for shares of subs' net income, dividends, and amortization. They can use the partial equity method, adjust investment account for the subs' net income and dividends. Or they can use the initial value method, which makes no adjustment to the initial investment account. That means you don't adjust a fair market value either, because we're talking about investments where you own more than 50%. What is the advantage of each? Well, under the equity method, the acquiring company total gives a true representation of consolidated figures. Under the initial value, it is easy to apply and gives a good measurement of cash flow generated by the investment. And partial equity method usually gives balance approximating consolidated figures, but it is easier to apply than the equity method. Investment accounting for acquired company. A parent's choice of internal accounting method for a subsidiary investment has no effect on the resulting consolidated financials, which means you're going to get the same results for the consolidated financials regardless of what method you use. The selection of a particular method does not affect the totals ultimately reported by the combined companies. The internal accounting method used does require distinctive procedures for consolidation of the financial information from the separate organizations, which means you're going to have to use some additional entries in order to adjust that retained earning balance of the parents if you use anything other than the equity method. So now let's take a look at our first example. On January 1, 2016, Big Inc. purchased 100% of Little for $574,000. We have annual excess amortization of $12,000. At the date of the takeover, retained earnings were $400,000 for Big and $200,000 for Little. And here are the results over the next 2 years. Assuming that the net income for Big does not include any investment income from Little, what are the amounts for consolidated retained earnings, investment income for Big, and the account investment Little based on the 3 methods? Now, under the equity method, what is the balance in retained earnings with excess amortization of $12,000 based on using one of the 3 methods? So we're going to start with the equity method. We have Big's retained earnings. We have their net income for 2016 plus the net income of Little. Then we subtract our dividends, and then we adjust for amortization. Now, we don't do anything for Little's dividends because those are an adjustment to the investment account. They're not income. So we get consolidated retained earnings at the end of 2016 of $438. We then adjust for the next year's net income, subtract out the parent's dividends, and subtract out amortization of excess over book for the sub. And now we have consolidated retained earnings of $496,000. It is the same for partial and initial method based on entry C. So what we're going to do, just want you to know, you're going to get the same consolidated retained earnings, but we're going to have some additional worksheet entries if we use the partial or initial value method. Determine investment income on Big's books from Little for each year based on each of the 3 methods. All right, equity method. The net income would be net income minus the amortization equals $8,000. Under the partial equity method, we show $20,000 because we don't adjust for amortization. And under the initial value method, we would use dividends because dividends would be the only thing that would be reported as income. For 2017, again, it would be the income minus the amortization. And then on the partial equity, we would add 30,000. Under the initial value, again, we would have only added 5,000 to the parents. Now, the next thing, what is the balance in the investment account? For the initial investment, it's the same for all three. But now we're going to adjust for net income for both the equity and partial equity method. And the equity method, we are going to adjust for dividends for both of them, but only amortization for the equity method. So this would be the balance at the end of 2016 in the investment account under the three different methods. Now, what about for 2017? Well, again, we would do the net income for equity and partial equity, the dividends for adjusting the investment account for the equity and partial equity, only the amortization for the equity method, and now this is the ending balance for all three of them. So that is the difference between the three methods, but what it also means is that in the end, the investment account really should be $590,000 for 5-3. So let's take a look at that. We're going to look at on 1/1/2016, Dan purchased 100% of KID for $900,000. What is the goodwill? And we're going to assume that the remaining life for excess current assets is 1 year and buildings is 10 years. First thing we need to figure out is what is our net assets or net book value for the sub. And what does the journal look like if we are keeping the sub separate? It would be investment in KID, $900,000, cash. Now, the next thing we need to figure out is what is the goodwill and what is our amortization. So we need to know both of those. So we came up with the current assets. For the first year, it would be $20,000. After that, total of $27,000, but in year 2, it would only be $7,000. All right, let's take a look at the journal entries made on in the parents' books. Now, these are actual journal entries. Update the investment in KID account on parents' balance. KID earned $150,000. KID paid dividends of $400,000. And we have amortization depreciation of $27,000, year 1. So KID gets all the net income, so investment in KID, which would be the balance sheet, and equity in KID's net income, which would be on the income statement. Next, we would adjust for the dividends. We would adjust the investment account, and it would be a reduction in the investment account. Now, then we would book the amortization as a reduction in our income from our investment account, and we would reduce the investment account. This is what the balance in the investment account would be at the end of 2016. Now we are ready to prepare work papers for consolidated financials with 100% ownership, and this I'm going to show you in part 4 of this presentation.